On the call, I am joined by Mr. Daljit Singh, Managing Director, Mr. Sudhir Goyal, Chief Financial Officer, and Strategic Growth Advisors, our Investor Relation Advisors. We have uploaded our result presentation on the exchanges, and I hope everybody had an opportunity to go through the same. I would like to open my remarks by giving a brief overview of the business environment and industry updates, followed by government's initiatives and our strategy for the same, following the operational and financial performance for Q2 and H1FY21. Post easing of the lockdown restrictions, Q2 went well for the overall room AC industry and surprisingly have witnessed an uptick in the retail demand for room ACs in Q2FY21 itself. We saw uptick in sales due to pent-up demand. Overall, consumer durable and electronics industry have witnessed a positive momentum in Q2FY21. The channel inventory levels are back to normalized level, and we anticipate growth for H2FY21. Of course, subject to no further lockdowns happen due to second wave of COVID. This was on the business environment. Let me spend some couple of minutes on RAC industry updates. In the recent notification issued by DGFT, import of refrigerant fill air conditioners have been prohibited. The Indian government has taken initiative towards self-reliance and Atmanirbhar Bharat, and ban on import of refrigerant fill RACs is one of the steps towards this initiative. This has opened up opportunities for domestic manufacturing. As per industry estimates, 30% of fully built RACs were being imported in India, valued at approximately 4,000 crore plus. These were primarily CBUs, which were refrigerant filled. Also, an equivalent worth of components are being imported in India, and we envisage that the move from government will help local sourcing of RACs. It will not be easy for OEMs to import non-refrigerant fill ACs and unpack and then fill the gas and get the unit tested and supplied to different locations across the country. This will primarily incur extra cost from gas filling perspective, as well as it will create a logistical hassles for the OEMs. It also negates the economic benefits of importing to a large extent. As per the above mentioned challenges, we believe that the local manufacturing and sourcing of RACs in India will increase, and Amber is well placed to capitalize this opportunity as one-stop solution provider to its customer and HVAC industry. Having said above the opportunities, I would also like to highlight on our capabilities and readiness to cater on the same. We have kept ourselves ready and have successfully completed a QIP of 400 crores in Q2FY21, which got oversubscribed by more than 5.5 times. The money raised from QIP has been temporarily used for paying off the debt, capex, working capital, and acquisition of balance 20% stake of Sidwal. With this opportunity in hindsight, coupled with growth capital recently raised, we are all geared up for the growth in domestic manufacturing of RACs and its components, and would endeavor to grab most of the market share. We believe this opportunity will further strengthen our presence in the domestic market and create a solid foothold for exports market. The China Plus One strategy is also unfolding opportunities for emerging markets. We have already started getting inquiries, RFQs from big global players for RACs as well as components. We have started component export to nearby countries and to US as well. However, the export opportunity will play out in the mid to long term because of various reliabilities and product developments for the suitable markets. In addition to our wide range of room air conditioners with multiple SKUs across all star rating and tonnage, including inverter ACs, we have successfully launched our wide range of offering in commercial air conditioner segment also. We have also strengthened our product portfolio for railways, metros and bus air conditioning in Sidwal. With surge in demand for air-conditioned coaches and multiple upcoming metro projects across the country, going forward we are optimistic of growing this segment as well. We are continuously investing in R&D for new product developments and better energy efficient products. With this, we will be future ready with the product portfolio to cater to the increasing demand across segments. I'll now take you through the consolidated financials. On revenue side, our consolidated revenue of Q2FY21 stood at rupees 408 crores as against rupees 623 crores in Q2FY20, a degrowth of 35%. This was majorly due to full season loss in Q1 FY21, which had led to pile-up of inventory in the system, which we believe are near normalized levels now. For the quarter, RAC contributed 36% of total revenues, while components and mobile application contributed 64% of the revenues. We have been witnessing good traction for our component business across verticals. However, the skew towards component in this quarter was also attributed to lower RAC sales. On operating EBITDA, for Q2 FY21, we witnessed an operating EBITDA of rupees 22 crore as against rupees 39 crores in Q2 FY20. The drop in revenues led to de-operating leverage playing out. Operating EBITDA excludes rupees 2.2 crores on account of fixed asset written off and sales loss on sale of fixed asset. We have resorted to various cost rationalization programs to curtail our fixed and semi-variable expenses, of which some of the benefits will be retained on long-term basis. Operating EBITDA margins for Q2 FY21 stood at 5.4% as compared to 6.2% in Q2 FY20. This is primarily also because we are in the seasonally weak quarter. PAT for quarter stood at rupees 3 crores as compared to 12 crores in Q2 FY20. Now coming to subsidiaries financials, on Sidwal, our railway and metro business segment has been able to withstand all the challenges from COVID-19. We have been able to acquire new orders and strengthen our order book despite weak economic scenario. Q2 FY21 revenues for Sidwal stood at rupees 47 crores and our operating EBITDA stood at rupees 13 crores. H1 FY21 revenues for Sidwal stood at 77 crores with operating EBITDA at rupees 18 crores. H1 FY21 operating EBITDA margin for Sidwal stood at 22%. We have utilized this time to enhance our capabilities in R&D. We have strengthened our commercial and bus and truck refrigeration solutions, along with continuous development for metros and railways as well. We believe that over long-term period, with increasing footprints of metro in various cities and increased manufacturing of air-conditioned coaches, we are confident of achieving good growth in Sidwal on long-term basis. On PICL, our motor subsidiary, revenue for PICL stood at rupees 17 crore for Q2 FY21. Q2 FY21, the PICL business saw an operating EBITDA loss of rupees 0.6 crores. In PICL, we have been working on new product development for various applications and markets. PICL has successfully widened its product offering from current PSC motors to BLDC motors. PICL is also in discussion with various customers to launch motors for washing machine and higher wattage motors for commercial AC segment. It has also been approached with RFQs from various large global manufacturers based out of US and Middle East. With increase in product offerings and enhance in our capabilities, we believe we will be able to cater domestic and export markets in more meaningful way in the near future. On ILJIN and Ever, for Q2 FY21, revenue of ILJIN stood at 81 crores and in Ever, revenue stood at 45 crores. H1 FY21 revenue for ILJIN stood at 98 crores and Ever 62 crores. With increasing efficiencies, newer product mix, addition of new customers and cost rationalization efforts, we have been able to increase in EBITDA margins for ILJIN and Ever. Operating EBITDA margin for ILJIN in Q2 FY21 stood at 7.4% as compared to 5.7% on YOY basis. Operating EBITDA margins for Ever stood at 5.9% as compared to 5.4% on YOY basis. H1 FY21 operating EBITDA margin for ILJIN stood at 4.4% and Ever at 2.3%. As the market is moving rapidly towards inverter ACs, we are confident of growing our revenue share from ILJIN and Ever going forward. We have been adding customers in both ILJIN and Ever, and now post completion of reliability of our own developed inverter PCB board, we expect to add more business in ILJIN and Ever in coming years. Our net debt on consolidated basis for 30th September 2020 stood at 178 crores. The money raised from QIP has been temporarily used for paying off the debt until the new greenfield facilities are in pipeline. To conclude, I would like to reiterate that our constant endeavor would be to increase penetration, and increase our wallet share in the existing customers, continuously add new customers, create a foothold in the exports market, and enhance our products with new technologies by focusing on R&D. With this, I open the floor for discussion.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Good morning. Thanks for taking my question. You had mentioned in the opening remarks that given the fact that inventory levels in the retail system has normalized, so just wanted to check with you. So in the second half, so you had mentioned that we will be seeing growth. Is it like we'll be seeing strong double-digit growth because companies also would be lifting more material given the fact that retail demand has picked up? So if you can touch upon that more. Hello?
Yeah, good morning, Ravi. So basically, my belief is that inventory levels which were held up when the lockdowns were announced of about 2.2 to 2.4 million air conditioners have now been consumed, and it is back to normalized level of pre-COVID levels. There are some brands who are witnessing some positive uptake, and there are some brands who are still at negative numbers, but on a consolidated numbers on the industry side, I think what we expect is that Q4 should be a very positive quarter for the industry. Giving a number on whether it will be high double digit or single digit growth is really difficult at this time, but yes, industry is expecting a good kind of a summers in coming Q4.
Got it, sir. And my second question is with respect to this ban on air conditioners with refrigerant. That benefit, I mean, those volumes, do we expect it to come this year itself, or do we expect incrementally companies starting to outsource to you, say, next year onwards?
So, Ravi, when this notification came, before the notification implementation date, anybody who has released letter of credits, so they are allowed to import the shipments. So I believe that the real impact of the notification will start coming into from February onwards. So February and March is when we are expecting volume increase from this ban on the refrigerant air conditioner import. I think largely the impact will be in the next financial year.
Got it, sir. Got it. And my last question is with respect to volumes for this quarter. How much was it, and what is the current capacity utilization across plants?
So volume on the Q2 what we have done is 1.9 lakh units, and capacity utilizations are at a lower level right now. We would be almost less than about 50 to or maybe 45 to 50% range.
Got it, sir. Got it. Thanks a lot, sir.
Thank you. The next question is from the line of Aditya Bhartiya from Investec. Please go ahead.
Hi, good morning, sir. So my first question is on the export side. Just wanted to understand how you seeing this opportunity shaping up. What kind of timelines would be required to meet all the reliability tests? Which are the customers for which some of these tests may have already gotten concluded? And how would you essentially look at revenues ramping up for this opportunity?
Good morning, Aditya. So exports have actually two verticals to look at. One is from component side and another one is from room air conditioner side. On components, we have already crossed the leg of reliability with some customers, and that's how exports have started. With some other customers who have just recently started participating in the RFQ side. So we believe that by FY21, the developmental cycle will be over with them, and by FY22, we expect some good orders coming in hand from those customers as far as components are concerned. On room AC sides, because the markets or the industry, this is one product which needs reliability testing, and the structure of the products which we use here in India are not the similar structure products what are used in US markets. So we have started developing these products. Our first sample will be ready to be shipped out by January. And next year, complete calendar year will be reliability testing and approval cycles. So FY22 is when we are expecting room AC exports calendar year to start.
Sure. And so when we speak about components, is motors going to be the biggest opportunity, or are you seeing opportunity on other verticals as well?
So we've started exporting motors and heat exchangers, and we are also now talking to some customers for PCBs also. But PCBs have not yet started exporting. It is just on the initial stages of discussions.
Understood, sir. And sir, if I remember correctly, when we acquired PICL, roughly 50% of revenues used to be from exports, and then those revenues, export revenues had come off. What would be that proportion currently, and how would you see that changing over the next 3 years?
Yeah, you're right. PICL used to export largely to Saudi Arabia, and then when the oil crisis hit, PICL was hit, and we changed the strategy towards domestic. Today, the percentage in PICL is about close to about 20% is exports and 80% is domestic. We expect this change in numbers to go up at least by about 60-40 ratio in coming 2 to 3 years time.
Sure, understood. And secondly, sir, on the commercial air conditioning side, would be very eager to understand how exactly are you seeing that particular opportunity, how large the market is, which are the product verticals wherein we'll be operating, and how have your initial discussions with customers been?
So by entering into commercial AC space, we have actually enhanced our horizon of addressable market. And that market is substantially good market to be in. And we've just launched 2 products right now, where we have started shipments also. During the lockdown itself, we got approvals and shipments have started, but on a very low volume right now. And we are now in pipelines to build up the whole product portfolio of about 18 to 20 products in next 2 to 3 years time. So once the whole product offering is ready with us, we expect a good volume number. We can't give right now because it's at a very early stage, but I can say that we will witness a good growth out of commercial AC segment.
And so the products wherein we'll be operating, how large is the market likely to be for that? And what proportion of customers would be the same as the ones whom we are servicing on the room AC side?
Some of the customers are same and some are new customers. And the market size, different reports have there are different research reports available, but as far as the ductable market is concerned, it's close to about 4,000 crore market. And if we add on the VRV side also, that's another 2,500 crore. So it's about close to about 6,500 crore of addressable market which we are trying to gauge on.
Understood, sir. Thanks a lot.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah. Hi, good morning, sir. So I have 2 questions. First, can you just share the outlook in terms of Sidwal? What is the current backlog? And we were expecting finalization couple of more orders. So how have we moved on that, both in terms of order book visibility as well as numbers delivering now in terms of volumes and sales for the rest of the year?
Good morning, Renu. So on Sidwal, recently we have won one large tender from, in fact, 2 tenders from DMRC, Delhi Metro Corporation. So these are about close to about 98 crores. And then on the revenue side, we've already informed that the Q2 numbers of Sidwal,
77 crores.
It's 77 crore for H1 and EBITDA of 18 crores.
So broadly, in terms of the timelines of execution of the overall backlog, we had mentioned of close to 250 crores plus of order book in this business. So as in, are we looking at timelines of next 12-15 months, or it should be broadly doable within the next 2 years? So how are we looking in terms of visibility for this portfolio?
So backlog has actually increased now with the new orders coming in. So we are having a order book in hand close to about 350 odd crores, which will be delivered in 18 to 24 months time.
Sure. And we did mention that in second half we expect the overall volume in the RAC segment to improve for us. Last year we did approximately 1.5 million units. So this growth that we're expecting is predominantly led by the existing brands or the market scaling back to normalcy and pent-up coming in fourth quarter, or these volumes would also include new customer or volume additions because of the recent imposition of import duty. And have we already started seeing stack up in volumes from customer? As in, if you can just share some more inputs in terms of how has your order books moved in for the month of October, November, and this quarter based on the current market environment.
So Renu, in October we've done flattish kind of a sale as compared to last year October, and I believe that quarter 3 should be a kind of a flattish quarter, and quarter 4 should be a good growth quarter, because in February and March the implication of the ban also will start coming in. So we expect growth in total H2 of FY20 current year. And on the industry side, I think industry is also looking into a good growth for quarter 4 right now. And in Q3, people have started stacking a little bit on the inventory side as far as the finished goods are concerned. So we believe a decent growth coming in quarter 4, because the pipeline, there is not large inventories in the pipeline now.
Got it. And my last question is, when we overall look in terms of the business, both from a working capital as well as capex side, by now would we be having more clarity in terms of the capex timelines and the quantum for the facility being proposed in South India? And do we expect the overall working capital and pricing environment to improve, given that commodities are moving northwards? So would we be able to take on the cost increases in the second half as volumes look to improve?
Yeah, we were already talking to customers, because as I explained you last time that the whole industry moves with a quarter lag of the impact. So that is already under discussion with all the customers. And some of the customers have also revised it, and some are on the way to revision it. And I think moving forward on the working capital side, we should be okay. I think we don't have any debts on the books. And also, I believe that moving forward, the kind of cycles we have been able to negotiate with the customers, it should be okay for us.
Sure. Any timeline now or in terms of the capex for South?
May be requested to come back in the queue for a follow-up, please.
Sure. That's my last question. I'm done. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Naval Seth from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity, sir. I have 2 questions. First, if I take from your remarks and look at the numbers of listed companies, somehow there seems to be a disconnect where your AC volumes are down plus of 50%, but primary sales for a Voltas or Blue Star or Hitachi is down less than 20%. So where are in terms of liquidation of inventory, that is also at normalized level. So why we have underperformed for second consecutive quarter over here?
So Naval, basically you are actually taking inputs from only listed entities, whereas we have 42 brands working in the market, and we work with most of the brands, and some of them are unlisted also. So some of the players, they already had a lot of inventories with them apart from the channel inventory. So that is what is being liquidated right now. And in quarter 3, just in the October, as I told you, that we have come to pre-COVID levels. So that's a reflection that orders have started coming in, and things have started moving in a very positive direction.
What was the industry decline in first half, if you can share that?
So industry, as per our estimates, decline is 32 to 33%.
Sure. And second question on import restrictions. Obviously, you would have seen increased customer interaction. So any new customer wins which you would have highlighted, because by Feb or March, as you highlighted, by that time your capacity would be 100% utilized because of the pre-orders. So will those kind of volumes get lost somewhere, or who will cater to those volumes over there in Feb and March, if at all those players who will start looking at volumes by then because of import restriction?
So we have in fact basically I would say added 4 new customers and large customers. We can't name them right now because NDAs have been signed, and we are looking forward for a good volume from them. Largely they were importing 100% of their requirement earlier, and we are in talk with further 4 customers to be added. So these first 4 have already been confirmed, and now next 4 we are talking to, and I think in next 15 to 20 days that will also be confirmed. But all the volumes from these new customers will start in February onwards, because they do have inventories right now and some of the shipments coming on the way.
Understood. Fair point. Thank you so much and all the best.
Thank you. The next question is from the line of Madhav Marda from Fidelity Investments. Please go ahead.
Yeah, hi sir, good morning. Thank you so much for your time. My question was on the export side. Once the reliability cycle, etc., concludes next year, just wanted to understand how we are placed from a cost competitiveness versus the other companies or countries which are exporting to the US. And in terms of product R&D, if there's anything that we need to sort of catch up on, or if you're already there with the new sample that we're planning to launch, if you could just give us some sense there.
Yeah, good morning, Madhav. So basically, on export front, especially on the room air conditioners front, China and Thailand are the 2 large exporters of out of close to about 65 million air conditioners are exported. 80% are exported out of China and 20% is done by Thailand. So if we compare the costs of the products of 1.5 ton, 2 ton, I mean, we are almost at par with Chinese and Thailand players. There are some countries who do have FTAs with Thailand, so there we are right now non-competitive. But with the countries where there is no FTA, we believe that we will be able to match apple-to-apple cost with for 1.5 and 2 tons. On 1 ton, we still have to work towards, because 1 ton is a large market which is catered from China in a huge volumes. So that is where I believe we will take at least 2 to 3 years time as we scale up and the economies of scale will come, and then we will get competitive in that zone also.
Okay. And of the 65 million units which are exported, how much is there any broad split for the 1.5 and 2 ton AC?
Well, largely, no, we don't have a number right now on the split, because every country has a different kind of split on this. So some of them use 1 ton and some are using 1.5 and 2 ton. And there are again differences in the wall-mounted split versus floor-mounted splits and cassette-type air conditioners. So it's a big metrics to be looked upon on a country-to-country side.
Okay. And maybe on the PCB side for LG and Ever, how are we doing on the reliability cycle, and by when do we see revenues picking up in a good way from these 2 subsidiaries?
So on LG and Ever, with 4 customers, we've already crossed reliability cycles of our own developed inverter PCB board, and we have started getting orders. We have already started shipping. Mass volumes will start picking up from next financial year, maybe March onwards. And 3 new customers are right now in pipeline where reliability has started. So I think in next financial year, that reliability cycle also will complete.
Okay. And just last question from my side.
The operator, Mr. Martha, may we request you to come back for a follow-up, please?
Yeah, thank you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Hi. My broad question is on the long-term growth driver. So what I presume is that Ember's growth would reflect the AC industry growth, whether it is consumer AC or commercial AC. B, that outsourcing is a trend would become faster than the industry growth rate itself of the AC. And third, hopefully Ember share within the outsourcing industry would expand. Therefore, these cumulative things will drive the long-term growth of Ember. Is that, do I believe that trend is basically intact?
Yes, good morning, Bharatji. Yes, you're right. The trend is very much intact. Earlier, when we got listed in 2018 January, almost 34% of the industry was outsourced. Now that number has further gone to about 48% or so. And our share from earlier 55% has gone up to 70% now in the outsourcing demand. And outsourcing growth is actually more in CAGR term rather than a normal retail market growth. Market is growing, industry is growing at about 12%, whereas OEM business has seen a growth of almost about 18 to 17%.
Gee. And to that, exports is an opportunity, components is an opportunity, would aid is an extra over the period of time?
Yes, sir. Export is a very big opportunity on a long-term basis, where we have just started taking baby steps, and we are seeing some green shoots also now on component side. Room ACs we still need to crack, but we have started working on that, and team is working in the right direction. And we believe in next calendar year we should be able to complete the reliability cycle of room AC for certain countries. And by 2022 we should expect some orders coming for room AC also. But on long-term basis we expect that as the economies of scale will ramp up here in domestic market, that will also give us a more leverage for exports becoming more competitive also. On the component side, yes, we've already started exporting, and we believe that especially motors will see larger traction in next year and next to next year. But then heat exchangers and other components also will start exporting.
Right. Which means component industry driven growth would probably fructify earlier. In about, say, 2-3 years' time, we would have a good eyesight of where we are headed. And probably of the full units may take a little longer period.
Yes.
In terms of history.
Yeah.
Thank you.
Thank you. The next question is from the line of Vikas Khemani from Carnelian Capital. Please go ahead.
Hi, how are you?
Good, Vikasji. How are you?
All well. Can you give some more, guidance or the idea about how should one think about the growth on the component side of the business and how large that could be? Air conditioner part, I think one, kind of get some sense, understanding, but how should one think about, in a little bit of more detail if you can share?
Sure. So on component side, we have 6 verticals in components, and we have an addressable market of entire consumer durable market, not only room air conditioner side. So in room air conditioner today, only 25% value addition is happening in India, and 75% components are being imported, where government is still thinking to bring up another policy intervention of phased manufacturing program on the component side by increasing some duties every year, so that gradually these components starts getting manufactured here. Right now, almost to a tune of close to 5,500 to 6,000 crore worth of components are imported in air conditioner itself. So if air conditioner CAGR remains in a range of 14 to 15% level, we can see that there's going to be a addressable market of almost about $2 billion worth of components, which we can certainly, out of that, we don't address compressor, but we address motors and PCB and heat exchangers and other components on AC side. Plus the refrigerator, washing machine and microwave oven, water purifiers where we are addressing, that is a space which is growing very well. In fact, in quarter 2, our complete revenue shift has happened. 64% revenue is being contributed by components, and out of that 64%, almost 60% has come from non-AC components. So our strategy of addressing components in consumer durable, including our ACs, as well as complete finished goods, is playing very well for us.
Right. So I think that's what I saw the trend in your. So is it fair to say that over 3, 4 years, 5 years, component will be a solid part of the strategy, and in fact, since it actually straddles across not only refrigerator but across products, will it be a higher growth part than the ACs?
Well, that cannot be predicted right now, but yes, in case we are expecting growth in all the consumer durable sector, like refrigerator, washing machine, microwave, and water purifiers. All sectors are growing in double digit. And, AC is, of course, one of the product which is the lowest penetrated level. So it will depend on the product mix, but moving forward, if I take you a little bit back when we got listed, our revenue split was almost 75-25% range. 75 was RAC and 25 was component. Last year we came to 60-40 level, and what we expect is in next 3 to 4 years time this split should come to 50-50 level.
Okay. And what's the sort of a follow-up question on this? How do you see margin trajectory in this part of the business? The component side.
So component side, some of the components, like we have a range of components starting from close to 6%, 5.5% till 12% range. So it will depend on what product mix opportunity we give up, but I think it should be in the range of almost RAC range.
Okay. And finally, on the exports front, which are the markets, we think, will be key driver? You mentioned Saudi, but is that Middle East and the market the only market target, or are you seeing any other areas of geography opening up, and anything on the developed market side also are you seeing?
So Vikasji, we have already opened our sales office in US, and we have a senior level team placed now in US. So US is one big market which we are expecting. Out of 65 million, 2 million market, 20 million air conditioners are imported in US itself. So that is one big part where we are focusing. And second is the complete Middle East part, including Saudi Arabia. So these are two geographies where we are focusing right now. But once we are ready with the product profile, of course, the neighboring countries like Bangladesh, Sri Lanka, that also will be catered by us.
Okay. Thank you. Thank you. All the best.
Thank you. The next question is from the line of Girish Achhipalia from Morgan Stanley. Please go ahead.
So thanks for the opportunity. Just a couple of questions. You mentioned that you're looking and closing down on 4 customers who would be on board with you on February, and another 3 to 4 in the pipeline. Could you just help us with what kind of volume opportunity that entitles you on the room AC side? And second question was on exports. Whilst it's early days and it's a more 2-3 year question, but just wanted some color around margin profile as to how you see it right now, because you said that in 1 ton you need to get more competitive, and the working capital, what kind of margin and working terms are likely on the export side as you see it right now?
So on the import ban opportunity, it's an opportunity of close to about 2.4 million air conditioners. And we are expecting to grab a majority pie out of this opportunity, where some bit of reflection will be seen from February onwards, but next financial year we'll see that large uptake from those volumes will come to us. And with all these 7-8 customers we are talking to, out of which 4 has been already confirmed. And on the exports margin front, components are almost at the same level of margins what we are enjoying right now in domestic markets. And in some countries, in some products like the commercial air conditioner, motor sector, that is at a higher margin in Middle East and other parts of the world. Whereas on the room AC side, I believe the margins will be little less right now as compared to domestic market, but it makes sense for us even at a lesser margin, because it's a complementary business, because largely their geography is such that the season of air conditioners in those geographies starts from May early May till it ends in October, which is a purely kind of off-season for us. So we will be able to use our capacities much better. Asset turns will be better, and it will enhance the margins overall on a consolidated basis.
Festive greetings to you and everyone at Amber. Thanks for the opportunity and wish you all the best.
Thank you.
Thank you. The next question is from the line of Ankur S. from HDFC Life Insurance. Please go ahead.
Yeah, good morning, Jasbir. Just had a couple of questions on the standalone business first. So, we've seen this big fall in the trade payables over the March quarter. Actually, similar fall in debtors as well. So what's driving this fall, and do you think it will reverse over the next 2 quarters?
I'll ask Sudhir to answer your question.
Hi, Ankur. Trade payables has fallen down. Reason is that we have to honor our payments to all the peak quarter or peak months payables as on 31st March. Because on the other side, there is no much of a business, and we need to honor them, and trade receivables are always down because of the COVID. So that will come to a normalized level which you seen in the previous years in the coming year.
Okay.
That will come back to those levels only, because that is our off-season. One side sale is not happening, and on the other side we have to honor our payments.
Okay. So your inventories have gone up, and fair.
Yes, right.
Fair. I get that. Okay. And so second, if you could just give us a split of your standalone revenues into air conditioners and components. I think you used to share that earlier, but it's not there in the presentation.
Yeah, so if we see our RAC value, it is around 147 CR in Q2. And if I talk about the AC components, it is around 90 odd crores, and balance is non-AC components. Around 170 odd crores.
So of the 200 odd crores, 222 was the standalone revenues, right? Of that, how much would be air conditioner and
on the console level? What I told you is on console level. 147
on a standalone.
On a standalone also, RAC will remain same, 147 crores.
Okay, and the balance is bigger. Okay, fair.
AC and non-AC.
And just one last question, sir. Now, when I look at the cash flows on the standalone again, there's been a loan to related parties of about, I think, 25 odd crores. What is that relating to? And, if you could just tell us a little more there.
See, we are doing some expansion in our one of the subsidiary PICL, because there we are getting a new type of motors, which is BLDC motors. We are expanding our capacity, and also we are taking a new place, a bigger place to cater those additional quantities. So for that we have given them the loan. Out of the proceeds of the QIP, that was the object also in our QIP process.
I get it. Okay. And just one last question to Jasbir, sir. On the inventory numbers, I remember you used to share, an absolute number, I think as of September, closer to 1.5-2 million units. Where would that number be now, as we get into, say, October, November, versus, say, what would have been the number last year? So just to get a sense of, when you say that inventory is normalized, what kind of inventory numbers are we talking about here in the channel? And
so when the lockdown was announced, there was a number coming in a range of 2.2 to 2.4 million air conditioners at the channel inventory, and which has come down to close to about 6 to 7 lakhs, which was a normal pre-COVID levels.
Got that. Okay, great. That's all. Thank you so much.
Thank you. The next question is from the line of Chinmay Gantri from Bharti AXA Life. Please go ahead.
Yeah, sir. Thank you for taking my question. Sir, with respect to the import ban which has come through, so with respect to your existing customers, how are the negotiations going on? And in terms of commitments or in terms of your negotiations, like suppose they were giving you 100 crore kind of a business, so that would kind of increase to like what level? 120, 110, 130? Any any guidance that you can give on this prospect, at least with respect to the existing customers who are already your clients?
See, the existing customers are expecting a double-digit growth as for the industry in coming summers, and that's what they are projecting to us also. And on the import ban, these were some of the customers were not existing customers, so they were completely importing 100% of their requirements, and now they are talking to us, out of which I've told that 4 of them have been already confirmed, and they are large customers, multinational companies. So we are looking forward for a good long-term relationship with them as far as that is concerned. On the number side, I would say that out of this 2.4 million which was getting imported, almost 70% was coming refrigerant filled. Others were only the IDUs. So that 70% we are trying to grab majority of it. I mean, I think out of that 70%, at least 55% or so is what we are expecting that business will convert into Amber's business.
And this 4 large customers would be broadly bringing how much of the business of this 2.4 million?
Well, they were the large importers. I think we can, I mean, it's very difficult to give numbers on their behalf, which will not like to comment. But on a basics of overall basis, if I say out of 2.4 million, if you see 70%, that is something addressable market because of this notification. And this run rate, at this run rate, this number would have grown in coming years. So we can stipulate kind of a matrix out of this number of 70%.
Okay, thank you.
Thank you. The next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Thank you, sir. Sir, one question on the subsidiary margins from my side. We have seen that subsidiary margins have expanded YOY. So just wanted your sense on, are these margins sustainable, or because of some bit of cost savings, these margins will go off in the coming quarters and coming years? And, how much of this margin expansion has happened owing to, say, gross margin expansion in some areas?
Yeah, good morning, Dhruv. So basically, we have expanded the margins in ILJIN and Ever and Sidwal, and we believe some portion of it is contributed because of lower expenses at this moment of time, and some portion would be maintained. So we will see a positivity in the margins as compared to YOY basis in these subsidiaries.
Sir, if you could just quantify something that, how much of it could be cost savings?
Well, it's varying from subsidiary to subsidiary. Like in Sidwal, in Q2, if you see, we have demonstrated about 27% of EBITDA. So at least a percentage or a percentage and a half should be maintainable for us, to add on what we used to be last year. In ILJIN, if I speak, we are at 7.4%. I would say last year it was at 5.5%. So somewhere about 0.5 to 0.75 is a sustainable uptake out of this number.
Okay. Thank you, sir.
Thank you. The next question is from the line of Abhishek Ghosh from DSP. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Sir, on this 2.4 million units which were getting imported and 70% was ref-based, which is your target market, are you seeing industry kind of doing any kind of things around to kind of being able to either get it without the refrigerant here and fill it here? Are you seeing that kind of thing happening, or Chinese discounting? Any movements around there?
Yeah, hi, good morning, Abhishek. Yeah, so basically, there are 2-3, I would say, solutions to this notification. Which one is that companies on a long term, some of the companies are completely changing their strategy from outsourcing from China or Thailand to India, where we want to capitalize that opportunity for. Second is some of the companies are also thinking of establishing their own factories. So they are talking to us for component supply on that strategy. Because the notification has just been announced near to the season, now in very short time, nobody can put up a facility. They need about a year's time at least to come up with the facility. So definitely, the stopgap arrangement will be to gas charge it at some location, maybe at our location itself, and then in phase 2 start complete manufacturing.
Okay. And sir, just a related question to this, we have close to 50 brands in this AC, and a lot of the things were dependent on the import and other things. So you think this will also lead to consolidation of the market going forward?
So it's difficult to predict at the moment. I mean, we've been hearing news of consolidation from last 5 years, but we haven't seen any consolidation as of now. But I think, yes, in the move, maybe 5 to 10 years from now, of course, 50 brands possibility of existing in the market is very difficult. So that will certainly happen. But I wouldn't see that it's in hindsight for next 2 to 3 years time.
Okay. And sir, in that light, so more in the medium term, as these large players even get bigger, do you think somewhere it is important that you get scale of business so that your unit cost of production is lower? Otherwise, to get pricing from these large players who are even getting larger will be difficult. Is that the way we should look at it?
So Abhishek, both things will play out. One is definitely the economies of scale. As we are getting bigger and bigger, definitely that there will be a delta in pricing. But secondly, this outsourcing and insourcing strategical decision is not in our hand. It is purely in the hand of companies, directors and CEOs. So what we have aligned with all the customers are that whether they want to insource or whether they want to outsource it, the strategy should not impact us. In fact, we should be deeply penetrated in their wallet share of offering of components and finished goods, whatever they need. So we have seen in past companies changing their strategies, and our business post their change of strategies have improved with them. In fact, it has grown multifold. So our endeavor is if 100 air conditioners today are manufactured in India, out of that 24% is being manufactured by Amber today as per our market share. So remaining all the ACs should have something or else of made by Amber in it. So that's a strategy which we move on.
Okay. And so just one last question from my side. The import substitution volumes which you're talking about, 2.4 million, 70%, and that's the addressable, and you've also closed some customers. Are the gross margins inherently better in those products?
Well, it will be in the range of what we are, supplying here. I wouldn't say that it is better or it is lesser, but it will be in the same range of what we have.
Okay, Jasbir. Thank you so much, and wish you all the best.
Thank you. The next question is from the line of Gopal Navandar from SBI Life Insurance. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. Sir, I just wanted to get a sense on the competitive landscape in last two years. A lot of small companies have come up, and some are being supported by the larger brands for outsourcing. So, do you believe that the kind of market share gains which we had in the last 2-3 years, we can still, capture some more market in the next 2-3 years?
Good morning, Gopalji. So basically, in last 15 years, we have seen a lot of competitive landscape getting changed. And we have, I would say that, safely navigated out of all the changes in the landscape whenever it happened. So newer companies will definitely continue to try to come and become our competitor. There are companies which are trying, there are companies which has tried and then left out. But if we as a company and management are more focused in giving our customers, I would say, unique solutions, a very comprehensive integrated solutions near to their plants and completely diversified one-stop solution for them in terms of complete finished goods range and in complete component range. So that becomes, and plus with a very strong R&D base. So this is the uniqueness which Amber has created, and we will keep on strengthening our uniqueness. But yes, definitely we welcome worthy rivals in the market. So whenever they come, definitely, we'll try to navigate out of it. But as far as now is concerned, I would say that competitive landscape, yes, there are companies, but the scale at which the companies are coming at very, very small levels at the moment.
Right. The second thing, between the IDU and ODU, which one is more easy to in-house, or say, as in terms of capital intensity or technology, or say, for example, if any brand want to, make it in-house, whether he will prefer IDU or ODU or anything, if you can give some sense on that.
Well, it depends on what budgets brand or maybe any company wants to start with, So if they are coming with a large budget in hand, definitely they can start ODU and indoor both together. And on the, I would say, complexity of the product point of view, we would say that IDU is a little bit more complex as compared to ODU.
Okay. And lastly, on this import substitution, which we are seeing because of changes in the norms. Just to get our numbers right, the last year, if I'm not wrong, Havells facility was not up and running, and there may be some larger, imports for them also on the ODU side. And if since their plants are ready now, so that number would have been reduced significantly or no?
So Havells actually was earlier buying from Lille, which has unfortunately gone to NCLT.
Yeah.
So that has shifted in-house for them.
Okay, so it's not an import substitute.
Yeah, I mean, I would not like to comment on behalf of my customer, so I don't have the numbers in hand.
Okay. So that number 2.4. Yeah.
Maybe request you to come back.
Sure. Okay. Yeah. Thanks.
Thank you. Ladies and gentlemen, due to time constraints, we will be able to take one last question. We take the question from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
On a broader basis, what are the unique advantages we provide to our customers apart from, let us say, costs in the attendant efficiency? What are the other unique advantages that we provide so that we become inevitable for them over a period of time?
So Bharatji, basically the unique, comprehensive and integrated solutions which we bring on the table next door to our client, having 15 plants in India, both for finished goods and components, with a very strong R&D. That is what is the unique proposition of Amber, apart from cost. So we have the widest range of products available in the complete room air conditioner range, starting from 0.75 ton to 2 ton in all categories, in all star categories, 1 star, 2 star, 3 star and 4 star, 5 star, even inverter ACs also. And then on the component side, we become one-stop solution. They don't need to have to deal with 10 suppliers. Amber can take care of the complete requirement of components, large critical components, and supply just in time to them as and when needed.
Sure. And from a return on capital employed perspective, would they find it more efficient to source it from you, or it is given for a small scale? I understand the capital efficiency may not be so very much in evidence, but for the larger customer, will his return on capital employed be superior by outsourcing from you or by manufacturing himself?
Yeah, because when they outsource from us, certainly they become lightweight and their ROCs improves. So it is ROC accretive proposition for them to outsource. But it again depends from customers' management and board of directors to decide whether to insource or outsource. So our strategy has been whether they want to insource or outsource, Amber should be able to service in both the strategies.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Jasbir Singh for closing comments.
So with the growth opportunities we foresee on the domestic and export front along with the government support, we believe we are well positioned to capitalize on this opportunity. Thank you everyone for joining us. I hope we have been able to answer all your queries. In case you require any further details, you may please contact us or our investor relations advisors, SGA, Strategic Growth Advisors. Thank you very much and have a good day ahead.